It's often difficult to catch a mistake until after it's made. And when it comes to your taxes, sometimes those mistakes can add up to a lot of money. In this video, I'm going to share with you the 5 tax mistakes I see investors make and how you can avoid them. Let's get into it. Hello and welcome to another video from Roth Financial. I am your host, Eric Persogna, CPA and Certified Financial Planner, here to help you increase income, reduce taxes, and invest smarter in retirement. So I've seen my fair share of tax returns over my career, and this year I was actually exposed to a great deal of individual tax returns and reviewed them for non-investment clients. And what I started to find or notice was that there were a lot of mistakes being made. Not just mistakes made by the tax preparer, but mistakes being made by the individual taxpayer at really no fault of their own. And I say that because had there been proper planning done prior to the end of the year, then a lot of those issues or mistakes could have been avoided.
Once again, things that could have been brought to my attention yesterday!
And really the problem is twofold. So for one, most CPAs, and I stress most because not all are like this, but most CPAs are very reactive, right? So they get a ton of tax returns, they try and churn as many as they can out before April 15th, and then they pretty much take the year off. No, I'm just kidding. But you get the idea, right? Tax preparers, CPAs are extremely busy, and they're focused primarily on getting everything done before that deadline. What's missed, however, is a lot of planning that could have been done prior and saving some of these clients a substantial amount of tax dollars. The second problem is that most financial advisors aren't qualified or aren't licensed to be able to offer tax advice. So when they're sitting down with their client and going over their investment strategy or their retirement plan, they're missing a huge component of that overall planning process, and that is taxes. So I am going to go over the 5 tax mistakes that I see investors make and how you can dodge them.
I would love to hear this.
So let's start with number 1, and that is having a business or having business income without a company plan. And I'm starting to see more Schedule C's and small business tax returns this year, whether that's because the gig economy is going full steam or people are just starting more and more small businesses. I'm not sure, but regardless of the reason, I am seeing a lot more small businesses starting up and a lot more small business tax returns. But what I don't always see are small business company retirement plans. And it's easy to notice that on a return because you don't see necessarily a deduction for contributions being made to such a plan, to a company plan. So depending on the size of your business and the number of employees that you have, there are a variety of retirement plans that you can choose from, or company plans that you can choose from, whether that's a solo 401k or a simple IRA or a SEP IRA. Whatever it is, I think it's important that small business owners consider implementing some kind of plan for their business. And the reason is that you can actually put a lot more away from a pre-tax standpoint in these type of accounts than you can in just a simple or a regular IRA. For example, a SEP IRA, I think the maximum in 2022 that you can contribute is up to 25% of owner compensation, or $61,000. Now, if you compare that to an IRA, that's literally 10 times the amount. So company plan, if you have a small business, it's definitely worth considering looking at some kind of company retirement plan.
Pretty good. Pretty good.
Number 2, making Roth 401k contributions when you're in a high income tax bracket. Now, don't get me wrong, I think the Roth IRA and the Roth 401k are probably the 2 best investment vehicles in the marketplace because you pay a little bit of tax now, those earnings grow tax deferred, and then in retirement, when you go to pull the money out, it is exempt from federal tax, as well as not subject to the required minimum distributions. So honestly, it's one of the best investment accounts, investment vehicles out there. But the problem that I see is when someone is in a high income tax bracket, so they have, let's say, a base salary, they get a lot in commissions, they get a big bonus, they might have some stock options that vest that are taxable, that pushes them up into the 30-35% tax bracket. And then the Roth 401k contributions don't necessarily make as much sense. It might make sense to maybe look, instead of putting all of that into a Roth, put some into a traditional 401k to get the tax benefit now and let those earnings grow tax-free, with the thought that there's a good chance income tax rates might be lower than what you're currently paying. Now, it's kind of hard to predict where tax rates are going to be in the future. There's a lot of people that think that we're going to have increased tax rates over the next several years. It's really hard to say, but I think if you are a high income earner and you're paying 30 to 40% in taxes today, typically in retirement, you're not going to have that amount of earned income or those bonuses or those stock options. You're pretty much going to have Social Security if it's still around, and you're going to have distributions from your portfolio. So if that's all you have, then there's probably a good chance that your tax rate is going to be a little bit lower than the 35 to 40% you're paying now, which means that it might make sense to, instead of putting all of your money into a Roth 401k, maybe consider splitting it up 50-50, or even go all in on the traditional 401k just to get that tax benefit today because your rate is much higher.
No way. That's great.
Number 3, and sticking with the Roth IRA 401k for now, is making a Roth conversion when you're in a high income tax bracket. So Roth conversions, if you aren't familiar with those, are basically taking a pre-tax account like an IRA and converting some of those dollars into an after-tax account like a Roth. Now, you have to pay tax on the amount that is converted, but you still get that benefit over time of having that money in the Roth, in that the account will grow tax-free or tax-deferred, and then in retirement, it'll be exempt from taxation as well as require minimum distribution. So it's a pretty popular, I would say, retirement and financial planning strategy that we recommend a lot of our clients consider. But it doesn't necessarily make sense when you're making $500,000 or $1 million a year, right? Because then, in a sense, you're paying taxes at a really high rate on those conversions. And believe me, I've seen some returns where the individual is making $300,000, $400,000, $500,000 and converting $10,000 to $20,000 into a Roth. And I don't know, maybe they think that rates are going to be 50 or 60% in the future, when that's very possible. But generally speaking, Roth conversion is best when your income is temporarily lower. So for example, a lot of recent retirees will no longer have W-2 income, and they'll kind of have those gap years between when they quit or retire from their job to when they start collecting Social Security. And during that time frame, their income, their taxable income, might be a little bit lower than it was before, or it may be in the future. And that is kind of like the optimal time to consider doing a Roth conversion, not necessarily when you're making $1 million a year.
I like your style, dude.
Number 4, taking short-term gains when you make a lot of money. So it's kind of in staying in line with the last 2 points. I see this more so with individual investors who manage some or all of their portfolio, and they like to trade a lot. And I'll come across, let's say, a 1099 form that has millions and millions of dollars of buys and sells, and at the bottom line, I see a gain of $30,000, which, on the surface seems pretty good, right? It's $30,000 profit. But when you look at how it's classified, all of those buys and sells in this case, in this example, are classified as short-term, meaning those gains are going to be subject to ordinary income tax rates. So that $30,000 in that example could result in that person paying an additional $9,000 to $10,000 in taxes.
I'm sorry, I just started hearing really loud circus music in my head. What did you say?
So I guess if you like to trade a lot and you like to manage your own portfolio, or if your advisor trades a lot, maybe have that strategy focused more so in a tax deferred account like an IRA, where those gains are sheltered until you have to actually pull the money out. Another option would be to wait at least a year before you sell a security for a gain, because if you wait at least 1 year from the date of purchase, then you are subject to a lower long-term capital gains tax rate. Lastly, number 5 is not taking advantage of foreign tax credits. So what the foreign tax credit is, it's basically if you have an investment in a foreign stock or a foreign ETF or mutual fund that generates foreign income subject to taxes, those taxes that you pay on that foreign income can actually be used as a tax credit, which, as we all know, is much better than a deduction because it's a dollar for dollar reduction in your tax liability. Where I see a lot of people, I guess, not necessarily misuse this, but just kind of neglect to take advantage of this, is when they have the majority of their foreign investments in tax deferred accounts like 401ks or IRAs. And I see this a lot when I'll come across a tax return with a high income earner and a high net worth individual that I know has millions and millions of dollars in investments. And I look on their return and I see like a whopping $8 foreign tax credit. So clearly I know that there's some opportunity to shift some investments around there. And the way to do that is to have more of your foreign investments in a taxable account like a brokerage account, and less so in an IRA or a 401k.
You just blew my mind.
And the way you do that is to kind of think about your multiple investment accounts like a brokerage, an IRA, and a 401k as one whole, as kind of like a pie. And establish a strategy for your one whole pie, if you will. And let's say that strategy is 80% stock, 20% bonds. And you want to be globally diversified, so that 80%, you want to have maybe 15 to 20% in international. Well, rather than make every account 80-20 with the same amount of international exposure, you might consider putting all of that international weighting in the brokerage account to get the most benefit from a foreign tax credit perspective. Now, if you look at that account individually, it might look like you have too much exposure to international, but really, when you take a comprehensive look at all of your investments, it should still be very well diversified.
That sounds
Comforting.
yes.
It is.
Do you have any Roth 401k contributions or considering a Roth conversion? Do you have any questions in general on your investments or your personal tax situation? If so, please feel free to give me a call or shoot me an email. I will respond to you personally. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks as always, and we'll see you in the next one.